Welcome to This Week in Coworking, where industry leaders get succinct, actionable insights.
Hey everybody, and welcome back to the This Week in Coworking podcast feed. We are once again here with a weekly recap, this time for week 44 of 2025. This week, we had a whole bunch of data and news and market moves from across the world. We're going to dive in this episode into some interesting events, some thoughts and a little bit at some M&A that's happening across Europe, as well as dig into some technical things that we're seeing, but also some trends that are emerging across industry or trends that are maybe emerging. We'll dig in and find out more. Today, I'm once again Hector Kolonas, and we are joined today by Ivan at OfficeRnD and Mike over at Proximity. Ivan, Mike, how are you both doing?
Thank you for the intro, Hector. I'm doing great. Thank you for inviting me to this podcast. I'm a big fan of your newsletter, and it's awesome that I'm going to finally get the chance to discuss some industry news.
Great to have you. Mike, how are you today?
Great week. It's week 44, the home stretch of the year, and looking forward to diving into the stories with you this week.
Absolutely. We are super surprised that this is the first time Ivan's been on this podcast, given that he is a thought leader that we follow personally. Great to have you here, Ivan, and thank you once again to OfficeRnD for sponsoring this week and for helping us make this a free and shareable resource for everyone in our industry to enjoy. Part of your sponsorship this week is actually talking about a webinar that you guys have planned for December. Tell us a little bit more about what it is and who it's for.
Yeah, sure. I know you guys are going to get bombarded by all kinds of webinars. So this one, we are going to make it count. It's focused on the top co-working and flex-based trends to watch out in 2026. We're going to be leveraging our proprietary data around usage and growth in the industry. The objective here would be to understand the key trends that are shaping the industry next year. We're going to try to provide some forward-looking insights and practical takeaways so you can anticipate changes and adapt your business model to stay competitive in this next phase of flex-based evolution. We're going to cover topics such as the state of the industry in 2025, some key learnings and observations that we have, the evolving member expectations, how tenants demand, hybrid work habits, and amenity preferences and how they're changing. Technology, of course, the growing role of AI, dynamic pricing, data intelligence. Also a topic of revenue diversification, how to employ new monetization models, what is the place of e-commerce in that, and decentralization to suburban and secondary markets, which is a trend that I believe we're all seeing, especially in markets like the US. Some innovative business models and landlord partnerships and how to structure them, and a bit of a kind of market outlook. And the best part, I think, is actually the speakers that we're going to be bringing along. I'm going to be moderating the conversation, so you're not going to hear me speaking too much in terms of opinions. But we're going to have James, who is a general manager of Clockwise Offices, a fairly large UK operator. David Walker, who is the founder and CEO of Coworking Consulting. Paul Lin, who is the co-founder and CEO of Coworkies. And also Ashley Proctor, who's the founder of Creative Blueprint and the executive director of Coworking Canada. So a very diverse group. You have consultants, you have actual operators, you have the tech side of this. So please join us on the 4th of December, 11 a.m. Eastern time. You're going to receive an invite, or you can go to OfficeRnD's website to sign up.
That's amazing, Ivan. I've got two follow-up questions. One, does it cost anything to attend? And two, who should attend?
No, it's absolutely free. We don't charge for our webinars. And in terms of who, basically every operator, owner of a space, or someone that is kind of looking into opening a space, and operations teams that are responsible for the growth of their locations and spaces, I would believe that would be the best kind of audience for this.
That's fantastic. I love some of the topics that you've said are going to be discussed. I'm a big fan of all the speakers that are going to be there. They're no strangers to the summaries within our newsletter. Great selection of people giving you that diverse background and insights. Talking about the topics, some of the things you're going to discuss at your webinar are actually in the newsletter this week. So let's dive in with the first news story of this week. We had two very interesting data sets drop out of the US. The first was more of an opinion piece, but kind of leans on the CBRE data that came out from 2024, really making the case that all landlords for all office portfolios should be allocating at least 10% of their square footage to flex. Before I dive in and climb up on my soapbox, gentlemen, what do you think? Should Should we be seeing that? And if not, why not?
Go for it, Mike.
I mean, listen, any good investment is diversified. And so if you take a look at any of your 401ks or any of your own portfolios, you don't have the whole thing in one stock. You don't have the whole thing in either stocks and not bonds. And so I think that this is not really controversial to say. I think 10% is probably the basement. It's probably the floor. I would say that we're more so looking at maybe 25 to 30% max for a really good mix. If you take a look at some of the larger developments taking over skylines across America, case in point one being the Comcast Tower in Philadelphia. There's a Comcast World HQ, there's condos as well as retail and restaurants. And I'm sure that there's some type of flex amenity in that tower as well. I think it was a great piece, well written, and I think it's kind of not that controversial. I don't think there's that big of a soapbox.
Ivan?
Well, I'm going to provide just examples from my experience with co-working operators that actually convinced landlords that it makes sense to have flex space in there. And I think back in the day, 2018-19, when WeWork was all talking about co-working, it was kind of easy to get some landlords excited, but they were mainly looking at it as a way to get on the hype train. They didn't want to miss out. In this stage, I think it's about survival. I'm trying to figure out central business districts. Buildings are still kind of half empty. Some of the developers and landlords are actually switching those buildings from commercial real estate to residential where it's possible and where it makes sense financial. But what happens with the rest of them? Are the banks going to take the keys to all those buildings? What is going to happen? So the two experiences that I have are entirely related to how Flex can help you activate a building and fill it up. One is from an operator and a customer, which we have a great relationship with, Silver Square in Belgium. Very cool concept. If you're there, visit them. I love their spaces. Apparently, they put a lot of passion into creating the space, the environment. But they had this large Belgian landlord called Befimo, who had, I remember the building we went to was a nicely made building, a little bit outside of the central business district, and it was empty. I mean, they had a hard time filling it up. So they decided to take a bet on Silver Square and their concept. It was a fairly expensive fit out back in the day, but it was a promise that once the fit out on the ground floor happens, they're going to bring in more tenants in the building than the traditional tenants. So they did a great job. When we started with them, they just made the fit out, and I connected with them several years after that. The building was almost 80% occupancy because people were so attracted to the cool space and it became more lively that when they got new tenants to come in, they were showing the flex space. They were showing the amenities there and the vibe and all of that. And people preferred that building because it was lively. Mm-hmm. A second experience like that one was actually here in Bulgaria, where Cushman Wakefield has a subdivision kind of company that they have a local presence. They started taking over some buildings that were struggling, and they had their own flex concept. This is like Cushman, the local business here. It's called MyFlex. They took a building which I visited 3 years ago, which looked super corporate, didn't look right. We were like thinking about going there, and I visited them yesterday. And the building is totally different. They now have 2 floors that is kind of committed to MyFlex. And they're bringing new tenants first to MyFlex so they can show them how their office can look like. They're bringing in more tenants that would like that flexibility and that are saying, okay, I want this kitchen to look like this. I like this. I want access to your amenities. And the building is now lively. So that's for me is like the base case. I'm not sure if it's 10%, 20%, whatever that is. But for activation, I think they should think about it.
Yes. I mean, it's definitely something we're seeing all across the industry. And I've been following MyFlex as well. It's fantastic implementation, bringing in that Cushman experience, but also leaning a lot on the learnings from co-working. What's interesting, though, is are we going to see more partnerships, more bringing in of operators to fill that 10, 15, 20% and operate it? Or are we going to start seeing more and more landlords implement their own brands, or more and more commercial real estate companies implement their own brands? I mean, we saw, in the newsletter alone this week, we saw kind of Mayo from, who owns Mayo again? So yeah, we saw Mayo from Landsec in the newsletter. We saw a Swedish real estate company sell their own brand to another brand, which we're going to dig into a little bit as part of our M&A discovery. And we saw, here in the US, we've got obviously the Tishman Spires of the world rolling out Flex across their entire portfolio. You've got Grosvenor over in the UK running a whole new Flex division now. But what do you guys think? Are we going to see more brand lords, as some folks have termed it, or is this going to be a very big opportunity for operators who have the right numbers and setup to go in and fill those buildings?
It's a very tough question. I don't want to kind of step on anyone's toes if they're a landlord, but I have been hearing about landlords adopting Flex for the last, I'm in the industry since 2018, and I've always been hearing like they're starting. Yep, they understand it. I'm happy that they're actually finally doing it, but I don't think that they have the DNA. It's a very different operating model, how they think about it. Given MyFlex and Cushman, they basically consulted with a ton of operators, looked at their products, took the best out of it. And I think they were fortunate enough to have like a local presence here where they separated the whole company. They were smart enough to understand that they cannot keep it part of the corporate structure if they want to succeed.
Yep.
So in a sense, the lead machine is the Cushmans out there, but the actual operator is still a separate entity. So I firmly believe that it's going to have to be the independent operators leading the way and finding partnerships with landlords. And yes, some of those landlords are going to evolve throughout the years, but I think it's going to be an extremely slow process and they're going to be dependent on those operators. So I think it's a great opportunity for operators to have more than just a lease and establish some sort of management agreements, partnerships. That's my opinion.
Mm-hmm. Mike, I know this is a topic we've discussed several times on the podcast, so I'm not going to pull you back into this. But anything to add before I want to go from this to that M&A news, and then we'll dive back into data. But Mike, anything to add before?
Let's dive into the M&A.
Yeah, great. So yeah, I mean, the great thing about like the understanding of landlords that this is not going anywhere is that they are making investments, and they have been making investments for a long time, Ivan, like you said. But it is a very different business model. We are seeing, two camps forming: the folks who've understood PropCo, OpCo structure and have structured themselves up to run that way. And folks are just like, you know what? This is great, but we want to get back to basics. We want to get back to managing the building. We want to be the PropCo. We don't want to worry about operations. We don't care about the toilets being blocked and the coffee running out and that stuff. We want to go back to the basics. And that's kind of what we're seeing over in Sweden with Lums offering what used to be called United Spaces. They were running around 10 locations before they decided recently to sell their entire business to their biggest competitor called iOffice. I think it's around a 2 million euro transaction from what I've been able to deduce from the article, but just an interesting addition to what we were saying a bit before, where yes, Flex is part of the equation, but it doesn't mean it all has to be done in-house. And kind of partnering it out and selling the business is a strategy we're starting to see more M&A activity across the world. We do have a marketplace, so people are reaching out and being like, hey, we're interested in selling 3 locations, we're interested in selling 1 location. So there is this movement happening. And so I just wanted to ask you both, do you think we're going to see any big M&A in the first quarter of next year in the operator side?
Well, define big. I think that there will be some and it just has to do with what's the right word? Cycles of business where typically things happen and things are really cooking at the end of the year, deals drop and then happen. So sure, we might see a few, but I don't know how big they're going to.
Ivan, any predictions? I'm putting you on the spot.
I would try to stay away from predictions because, like 50% of the time I'm going to be right. The other 50. The only prediction I can make, and this is again based on data and conversations that we are having, is that the market is reaching a point in which we are looking at stability I mean, we went through COVID, we went through all the initial kind of bankruptcies and problems and challenges, and landlords not knowing what to do and all that. And I think we're reaching a point where we're building a stable foundation. And part of that stable foundation would inevitably be kind of reevaluating if this is really the business for you. There's other people that are stronger. And I think there's going to be consolidation. So how big? I don't know. But I think the trend of continued consolidation will continue. That's the only thing I can be certain of.
I'm going to agree with you there. I also am going to make a prediction because I'm 50% of the time I'll be 100% right. So I think we're going to see more PE roll-ups. I think there is a huge opportunity of indie operators who are looking to get out. They're stuck in a location. A lot of these operators have similar tech stacks. There is something to be said about economies of scale. We've seen this roll out in APAC pretty successfully with the Flexi Group. We're seeing it in Australia as well. We're seeing it here in the US where it hasn't been successful and kind of got paused. A lot of the money kind of stopped while the market was reshaping this year. But I am thinking we're going to see a roll up of indie operators or smaller networks into the beginning of next year, because honestly, if I was a PE fund, I'd do it, right? The opportunity is there. The operations there, they are cash flow positive mostly. Maybe they just have too high expenses and that's why they are not profitable. Roll that into a unified stack with kind of centralized operations. And I think there is something there. Now, this is not investment advice. This is not that kind of podcast. This is for entertainment and educational purposes only. So to give you more context as to why I would do that, we did have some data coming out of Yardi and the Co-working Cafe team this week, where they really shared the fact, we love these quarterly reports that they put out using their data. They said that in the US, we've now reached 8,420 locations, and we now cover over 152 million square feet of office space within the co-working industry. And this is within, I think, the main 50 markets. So there are outliers that are not in this data, but it's a really interesting data set that we love to kind of dig in and share. Gentlemen, were there any numbers that screamed at you and caught your attention from this quarter's report?
I think that all in all, none of the numbers were surprising. LA still is kind of holding its place with how many locations they have total. It is, though, interesting to see that Texas is really starting to get up there for number of locations. Texas as a state has over 600 locations. LA alone has 322. It was interesting to also see zeroing in on the difference of pricing. So, for example, a full-time membership in New York is running about $339, and Salt Lake City and Columbus, which are growth markets, are looking at like $150 a month. The pricing disparity is still there based on the market, but it's interesting just to kind of see. It's always good to have the insight on the numbers, that's for sure.
Yeah, it's from my perspective, it's always interesting to compare versus what we have with our customer base. The good thing is that we are both aligned with Yardi on this one. There is kind of a stable plateau in terms of growth, because compared to Europe, we have kind of the EMEA numbers as well. Actually, EMEA is the bright spot for some reason right now in co-working. Like, we're seeing location growth and more expansion there versus the state. The state is like just reshuffling and some locations closing, some opening, but the net effect is kind of the same. The piece of the data that I'm actually very interested in was the fact that the US seems to be adopting very heavily this kind of idea of having more suburban co-working, and they seem to be sprawling. I just remember when Mark Dixon, I think it was probably 4 or 5 years ago, I was listening to one of his events in somewhere in France or whatever, where he was like talking about this 15-minute city concept and the fact that suburban co-working is going to take over. And I'm like, oh my God, I mean, come on. I'm not sure if that's going to be the case. And now I'm starting to see that the US is kind of a breeding ground for these suburban locations. So I'm most curious about that one. Are we going to see more suburban locations? I'm also hearing about some great concepts like lifetime work, customer of ours. They're combining, it's almost like not exactly a country club, but like a club space where you have a little bit of co-working, family-friendly facilities, a gym, cool restaurant, and all of that, where you kind of have everything combined. So you can have basically a center in the suburban area where you can go to work and take your kids and all that. I'm a big fan of this concept. I very much like it, and I hope it takes off because we need to stop concentrating only on. But that's what kind of struck me there.
Yeah. I mean, it's really interesting. We are absolutely, I mean, it was a very big topic that was kind of bouncing around all of last week or whenever we were at the conference. Although from the numbers, we have seen growth across all the major CBDs as well. So there is that reshuffling. There is this idea that there's going to be a change of guard for some of the spaces. We did see Central Office enter the San Francisco market by taking over an old WeWork location. We are seeing a bunch of landlords make their own experiments with pre-fitted out spaces. So that's definitely bubbling up. But on the flip side of that, we are also seeing new locations. I mean, Kohatch is on a tear. They just celebrated 10 years this week, and that is their market, right? Suburban town centers, really kind of creating these hubs in these less central regions. I just went back while you guys were talking and looked at what was last quarter's numbers to this quarter's numbers, because I was like, the number looks different. So I went back and checked, and we actually saw the Q2 results were showing that there was 7,742 spaces, and that was a 1% dip from the previous quarter. So if we take that 7,000-ish, 7.7, and we push it to 8.4, that is around a 700 space increase from the last quarter. So we are still seeing that growth, even though it's not that dramatic pop that we used to see. Given that there was a 1% dip last quarter, I think it's pretty healthy numbers. And it goes back to what we were saying a little bit before. It's coming up to the end of the year. A lot of the spaces that were kind of set up in the beginning of the year are now opening. So it'll be really interesting to see how the numbers shake up in Q1 and Q2, and whether we're going to be able to see that plateau, as you said, Ivan, or if we're going to keep seeing that pop. Once again, going back to the source for the data, it is only across the 50 largest markets, right? So that CBD, that non-CBD, that suburban space, are they being counted? And if not, will they be counted and when? Because that's going to change up the numbers quite drastically. I know that we're going to dig into the UK and Ireland data next week. And this is kind of something that Mike and I have discussed a few times, is as you add non-CBD locations into the numbers, it looks like there's a dip. It looks like pricing's coming down. It looks like there's a crash coming, but it's actually just the fact that the more local or more urban and suburban locations have lower pricing compared to the city centers. And so it averages out. So just be really interesting to see as, Yardi and Cohen Cafe expand this data set. Will we see that dip? Will we remember when we're reading it then that, hey, this is not a dip in pricing. It's actually just a balance of the average. Really interesting numbers coming out of this as well. And I'm going to put a call out to you, Ivan. Share more of that data, right? I know you guys have it. Put it into a report that we can share, and we'll get you guys back on to discuss and maybe compare and contrast it to what other operators are seeing or other platforms are seeing.
Yep. We'd be happy to.
Awesome. Totally put you on the spot there. This is a super friendly podcast. We don't ask you for anything. I want to dive quickly into two tech pieces that caught my eye, and get your opinions on those. The one is we saw Alliance Virtual Offices share that they're investing millions of dollars into 3 elements of their business. What caught my attention was that, yes, they're launching a booking platform for their virtual office clients. But what's interesting is all the investment is going towards making the operator's business more seamless, more automated, more streamlined. And that is a trend that we've started seeing. I know OfficeRnD, this is a big part of what drives you guys, making things more connected, making things more automated and seamless for operators. Now, full disclosure, they are working on their booking aggregator. It's running on Synchro Rails. So I do know a little bit more about what they're doing there, but it's very interesting to see platforms starting to position their upgrades as operator focused as opposed to end user focused. A lot of the time over the last couple of years, every time we've seen aggregators, we've got X number of people on our map or X number of locations on our map, or we have improved the booking process for the end user, but we're still going to send you emails and call you and send you contracts unsolicited, the stuff that aggregators liked to do in the past. I'm not saying Alliance ever did that, but it is trends that we've seen. Are you guys seeing this shift from at least the language that platforms are using, positioning their upgrades as this is going to make your lives easier? And has it always been like that at Office R&D, or is it a new trend that you're starting to pick up on?
Well, I don't think it's an entirely new trend. And I believe it has to do with the survival of businesses that are focused on aggregation and marketplaces in general. We have spent exorbitant amount of time to figure out the business case behind having a marketplace. And believe me, we are fans of the concept and it has been on the table multiple times. The part that always stops us is that when you look at the market generally and all the marketplaces out there, I'm sorry to say it, but it seems like co-working is just it. I mean, it's you cannot have so many kind of marketplaces for co-working. You need a few so they can survive out of the business model that they have, which is some sort of a take rate. So I feel like if you look at all the marketplaces out there nowadays, they're trying to have a subscription SaaS component to it, which inevitably means you have to sell software to someone. You're not going to sell it to the end user. You're going to give it out for free. So you have to sell something out to the operators. So I think it's just a natural move to sustain the businesses. And also you're making yourself more attractive to investors because we all know multiples for transaction-based businesses and multiples for SaaS-based businesses. And as a result of that, I do believe that the trend is going to be to get them in that direction. But again, my opinion still stands. The most important asset here is not like the demand. You can get the demand, you can buy the demand, you can get eyeballs on your website through money. The hard part is getting the supply and to make sure that you orchestrate that supply and you provide that live availability pricing. And you also make sure that it's a very curated list of spaces that give enough global coverage, but at the same time provide good experience, which I think is extremely hard. So a little bit of a longer answer, but I think it's driven by the desire to survive in this market, more or less.
Yeah, I mean, I've run a marketplace in this industry. I know what the unit economics are, and there's a reason why I don't run one anymore. So I completely agree with you on all those pieces, but I do also, the cost of the moats are disappearing, right? Everything's drying up. The way to get into this market and launch an aggregator is becoming more and more effortless. It's becoming more and more affordable. I think we're going to see a lot more before we get to that kind of consolidation phase. It's already starting to happen with the larger players, obviously DeskPass, etc., kind of being sucked up into groups and Worker forming their consortium. There is a lot of movement happening, but we're also seeing good and bad fly by night and new concepts in the aggregation space. And I think all of that is kind of moot because AI browsers and ChatGPT and LLMs are going to change the booking process completely. So aggregators are going to be something we talk about hopefully in a year and be like, remember aggregators? But let's see who kind of reacts to that and how they react to that, because it's going to be a very interesting shift in the AI kind of tidal wave that's building up around kind of how you search, how you engage with different products on the internet. It does affect e-commerce. It does affect your websites. It does affect your operating stack. All of these things are things that you should consider, and we can definitely spend another hour drinking beer or coffee and talking about this all, but I'm going to spare folks listening to that again. But there was one more topic that was interesting in this newsletter, and that was this idea of dynamic pricing. It's a concept that we've heard about. It's a topic that's a front of mind for me because I'm busy producing the next Undercurrents, which is a deep dive into dynamic pricing, where it works, where it doesn't, what's the different types, all the questions. But the thing that caught my attention this week was a post on a subreddit called Mildly Infuriating, where two people standing right next to each other both try to book the exact same Uber ride from two different phones at the exact same time, similar battery levels. One was charged $50 more than the other one. My question to both of you is, what happens if we leave dynamic pricing unchecked and two people trying to book the same meeting room see such a drastic change? Is that a good thing or a bad thing? And we'll end on that.
I think that it's something that already happens. People pay different prices for hotel rooms based on what site they go to. Those booking sites are starting to offer rewards programs where it's an Amazon Prime model. So if you are paying a subscription to be part of booking, you get a lower price hotel room than you would available on the public site. I don't think the question is so much as, is this okay? It's just a fact of business. It's a matter of how will operators have a sense of say as to how large of a discrepancy that could be? And also, what are the aggregators doing to come up with those different amounts? Because, for example, people were testing this with Uber in a different scenario, going to the same airport, but selecting different airlines impacted.
Wow.
So when you selected, I'm going to JFK, if you were to hit JetBlue versus Delta, the Delta passenger was paying, I think, $46 more in that scenario. So my question is, my feeling is, yeah, it's not the end of the world. This happens, but as an operator, you have the right to have some sort of say as to how much of a difference that is, because ultimately you're the one dealing with the complaint. And also, what are the booking aggregators doing? I like how you reference the battery power, Hector, because that's also something that we've seen apps do, that they know that your battery is almost dead. They're going to charge you more for something. So it's just very interesting to see what the variables are that they're using to come to those price points.
Well, as we already mentioned, is it ethical? Probably not. Is it infuriating? Apparently mildly. I would say a lot. And by the way, I didn't know that they were getting into so much details in terms of how they were pricing this. So this was pretty cool to actually find out. I think for our industry in general, I'm not sure if there is so much volume that it requires such a complicated engine, because Uber has probably hundreds of thousands or million transactions happening every day. These differences add up enough so it outweighs the bad reputation and people getting infuriated, because everybody hates surge pricing, let's face it. But I mean, you're fine with it. I do still believe that co-working and flexible workspaces, the differentiation between just going into a traditional office is the hospitality piece and the brand and the feeling that you get when you get into that space. And is it worth, because you're going to have how many transactions per day? 10, 15, 20, 30, 50, whatever. I mean, probably if you're IWG, it makes sense. But for most of the others, I'm not sure. Is it worth the $500 that you're going to make on top? I'm just not sure if the volume is there and the gain is there. So my kind of feeling is that we should focus on what matters, like days of the week, and have some level of customization, but going into so many variables, it's just not worth the risk unless you're one of the huge operators like WeWork or IWG, which has enough volume to make a difference on their P&L.
Yeah, I mean, volume is definitely the right area to look at there. And it's going to be curious, as Mike was saying, if it's going to change, if any of the aggregators hit that volume, right? Across the, because I mean, that's the difference between Uber and aggregators right now, is oftentimes you know who the space is, you know the brand, you know who it is. Uber, as long as it falls into the category of the car that you want, you're not picking, Hector. You're not picking Ivan to pick you up. You're not saying, I want Ivan to pick me up every time I go to the airport, right? You are given whatever the algorithm gives you. And I think it's slightly different with desks and workspaces. So I'm going to caveat that. But I am going to thank you both for sharing your morning with me and for sharing your insights with all of us. I look forward to seeing you both again soon and having you back on the podcast as soon as possible. Thanks again, folks. Have a great week. We will be back in your podcast feed on Monday with another exclusive interview. Please look after each other. Have a fantastic Halloween. If you're partaking in dressing up, have a fantastic Halloween, and we will be back again soon. Thank you, guys.
Thanks for the invite.